Hey everyone, Disney reported their quarterly earnings yesterday, and we're here to make sense of it. The good, the bad, and to separate the noteworthy from the noise. There was a ton of good news in the release yesterday. Disney absolutely crushed the quarter. But, as you might have noticed, shares are getting hit pretty hard. There was some management commentary that is weighing on shares. Now, typically I like to go through the quarter by reviewing the positives and the negatives, and to go through what are the questions going forward. But before we get to that, bear with me. I want to go through just a little bit of context for who Disney is. If you look at their earnings release, you might just be totally overwhelmed. They're like this sprawling media and entertainment company with a ton of segments. So what I've tried to do for myself is reorganize their reporting segments into a simpler structure that's easier to understand. It works for me, and I think it might work for you too. Okay, so here we're going to take a look. This is how Disney reports. They separate it into entertainment and sports and experiences. And inside entertainment, you've got domestic and international linear networks and direct-to-consumer, content licensing. Sports, right? ESPN, international and domestic, Star India, which they have a deal to divest 2/3 of it. Parks and experiences, domestic, international, right? It's like, okay, fine, but what is the company really? Let me see if I can get over here. So what I like to do is I like to basically call Disney classic Disney, and that's our theme parks, movies, and merchandise. TV Disney, that's your cable networks, your ABC, Disney Channel, and ESPN. I put all the linear TV and ESPN. And then streaming over here. And that is your Disney Plus and your Hulu. So, and this is how Disney looks by revenue over the last 12 months. So this is how much each of those three businesses have generated in revenue over the past year. And you see, right, like classic Disney is 45% of Disney's segment revenue. TV 31%, streaming 24%, right? Simple enough. And a nice, clean 3 divisions, and you're pretty, right? I mean, you can tell how the businesses are relatively sized. Makes for pretty decent Mickey ears right there. But then we go over to profitability, and that's where we have an issue. Classic Disney is oversized. It is a cash cow, and it generated over $9 billion in profit, 60% of company segment profit. TV is generating a lot of revenue. 2/3 of that is ESPN. Linear networks are still generating profit, but less so, right? As more people cut the cord, I should say. But here's the real problem, right? We have this disfigured Mickey ear. It's not profitable. It should be out over here and much bigger, but it's actually losing money. So it cuts into the profit of the profitable businesses. Streaming over the last year has lost $530 million. And I have to say, that doesn't sound so bad, but it was much worse. And it's actually improving pretty rapidly. But until investors see that be profitable, sustainably, over an extended amount of time, I don't think investors are going to put a lot of weight behind it. If it's inconsistent in its earnings profile going forward, profitability wise. So that's the context of who Disney is. I really like thinking about Disney in these terms. It's oversimplified and just making it 3 businesses instead of 6 with international and domestic, so that 12 different businesses. Just thinking of it in these simplified terms, and of course I go into more detail. Here's the Disney revenue analysis. And you can see, right, I go into greater detail within Disney Classic and TV Disney. So let's do that. Let's start with that right now to see how they did in the quarter. Actually, before we even do that, I'll just say let me see here. This is what they did versus, it's just a little off screen. Can I move that on screen? Perfect. Okay, so this is what they actually did versus consensus. So entertainment beat, sports beat, experiences came in a little light of consensus expectations. Total revenues beat. EPS, like I said, they blew it out of the water. They beat consensus by 20 cents. But let's look at the revenue analysis here. So yeah, just segment by segment, right? We have the year ago revenues here, what they actually did this quarter, the difference year over year in dollar terms and in percentage terms, and then just some cursory commentary, my own opinion here. Movies, I thought they could turn a profit, but there were some tough comps. They did have some decent movies in theaters last year, and Inside Out 2 just came out mid-June. And so it just didn't have enough time in the quarter to get it over the hump and turn a profit. So tough comps, but with the movies that they have out now and that are about to come out, we've got visibility to super results. So yeah, revs were down 4% year over year. We can look past that because they're about to crush it. Parks revenue was up 3%. Theme park admissions were up 2%. Half of that was pricing, half of that was increased attendance. Okay. Merch was down 5%. Yeah, $53 million at the end of the day for a company that makes $91 billion a year or over the past year. That's negligible. So overall, revenues were up. Not great. It's okay, but it's not great. On the TV Disney side, no surprise here with network cable TV, declining 7%. That is something that's in secular decline. We're going to be hard pressed to ever see that number grow year over year. ESPN up 5%. It's pretty decent. Streaming. This was really, really solid, good growth. So just for some context here, I put in the notes, growth accelerated 2% from the prior quarter on a year-over-year basis. So like last quarter, it was up 13% year-over-year. This quarter, it accelerated up 15% year-over-year. And Netflix also accelerated 2%. They had been at plus 15. They're now at plus 17. So each company accelerated the year-over-year growth by 2%. Netflix is still ahead of Disney, 17 to 15, and last quarter it was 15 to 13. So good. I give it a good grade. Not an A. an A would have been, out accelerating Netflix. But I give it a B+. So yeah, overall, nearly 4% revenue growth. It's pretty solid. Here we get to the profitability analysis by segment. So again, movies were down 4%. 4% there. Down $98 million. And on $98 million fewer dollars in revenue, movies made $366 million more. This is an absolutely phenomenal result. And right now, the street really doesn't care how well movies do, but they will, and they will soon. And this is something I'm actually really excited about. Let's take a step back. Disney is a company that we showed over the last year has made $15.5 million in segment profit, right? 9.2 plus 6.8 minus the 0.5. Well, if you take that $366 million improvement in year over year for movie profitability, let's say you annualize that, then that's $1.5 billion in improved profit. That's 10%. So you can get 10% improvement in company-wide earnings. The rest of the company can be the same. You can still be, dragging your feet through the mud in with trying to get increased profit out of Disney Plus. You can still be dealing with your secular decline in linear TV. You can get a 10% improvement in earnings just from what you did in if you can replicate the improvement in profitability that you got from movies just this quarter. It's a huge deal. And movies, up until this point, has lost money over the last year. So super easy comps. Disney can absolutely replicate these kind of results going forward, especially with one of the top 10 all-time best-selling movies ever in Inside Out 2, the top grossing rated R movie ever in the Deadpool Wolverine movie, with the Mufasa movie coming out and Moana 2 coming out later this year. Movies, so that's the top line. Revenues, they're going to make a ton of money in revenues, but what I'm excited about is their attention to costs and what they were able to accomplish. This is phenomenal execution. Bob Iger is limiting studio costs, and it's working. And the street doesn't give a hoot about movies right now for Disney as anything that's going to move the needle. But I don't think that's going to be the case for too much longer, because the results, the profits that are going to come out of movies over the next couple quarters, 3 quarters, 4 quarters, are going to be really, really impressive. Yeah. So, again, last thing I'll say on movies, right? I said they'd been losing money. Last year, the operating margin for movies was negative, minus 5.1%. And here, 12%, right? I mean, what a turnaround year over year. Just, again, phenomenal in all caps. Parks and vacations, right? I mean, that's your theme parks and your cruise ships. They saw a dip. Even though they had increased revenues, they saw a dip in profitability year over year. The operating margin went down 2%, 200 basis points. They are investing in their parks. And yeah, they have some increased costs as well, increased labor costs, which are impacting the segment. Yeah, but ultimately, I think it's fine. I'm gonna come back to this, when I go over management commentary, because they said some things that really shook some investors up. All right, I'll just do it now. I have the quote. Where do I have it? Let me go. It's actually in a different spreadsheet. Bear with me here. Yeah. So here's the quote. We expect that the demand moderation we saw in our domestic business in Q3 could impact the next few quarters. Right? What they said was that they really saw a moderation in demand in June. Towards the end of the quarter in June, and when they guided, is the guidance here? Yeah, we expect Q4 experience and segment operating income to decline mid-single digits. So call that 5%, and that's what I did here. They had earned 1.8 billion in the prior 4Q. Multiplied times 0.95, you're looking at 1671, 1.67 billion in profit. On a 5% decline, maybe in revenue on the top line, we're looking at 21.5% operating margin. Disney Classic, right? Like parks. Gosh, the operating margins are so great. In general, mid-20s. I don't see this dipping into the teens. I don't see operating margins dipping into the teens at any point over the next year, even with the investment, the increased labor costs. That's my take. And so I have a hard time, given the turnaround at movies, given the improvement in other segments of the company, movies and streaming, which we'll get to. I think it's really modest. But you start hinting at declines, and Wall Street is just going to take that, and they're going to imagine the boogeyman, and there's going to be very little nuance. And, they want growth. And if you don't give them growth, you give them a decline for the exits. And we know how big a factor classic Disney is, right? 45% of revenues and 60% of profit. So anything incrementally negative, anything hinting at declines, really hard for Wall Street to look past that in the short term. TV Disney. Look, the network TV revenues were 200 million lower than the year prior, right? And on 200 million fewer dollars, they only made 60 million less. 59 million less, right? So the operating margin actually went up 60 basis points. So increasing your profit margin when revenues declined 7% is pretty incredible. That's pretty strong execution. That is really solid execution on costs. I think Bob Iger and his executive team deserve a lot of credit here for what they're doing, just across the board. ESPN, saw a slight dip in their operating margin. Not great, but pretty negligible. Streaming, excellent progress. Disney Plus and Hulu almost turned profitable. But it's nearly $500 million better than last year. You see the operating margin went from negative 10% to almost profitable. They almost did it. Now, if you read the press release or some things in the media, they'll say streaming turned to profit. That's when you include ESPN Plus. I keep ESPN Plus together with ESPN. That is its own product in my view. Streaming Disney for me is just Disney Plus and Hulu. It's easier for me to understand it that way. But I mean, nearly 1,000 basis points improvement year over year. Excellent progress. This is a business that will turn profitable over the next year, if not next quarter. Here are some basic notes. Revenues beat, profitability was great. EPS beat consensus by a ton, 20 cents. It is a turnaround story, and even though Disney delivered, there isn't confidence that it's terribly sustainable when management has that commentary around parks. And Disney Plus and Hulu are close, but not quite yet to profitability. But I think there are reasons to be really, really positive on streaming. And here's why, right? Like, pricing's going up, subscribers are going up, advertising revenues are increasing, right? So it's not just about subscribers and price per subscriber. Disney is trying to get people into, they're jacking up the prices on the no ads version to extreme levels. The more people they can get to subscribe to Disney Plus with ads, then they can get that recurring monthly revenue plus all the advertising dollars in there. So, it's a 2-for-1 special as far as Disney management is concerned. And so, yeah, subscribers are going up, advertising dollars are going up, pricing is going up, and Iger's doing a great job. Iger and team, I should say. It's not just him, obviously. It's a team effort. They're doing a great job on costs. So for a segment here that, for all intents and purposes, is break even, they finally made it up to essentially break even. The real question for us going forward is how much money is this business going to make over the next 12 months? People were already pretty bearish on Disney, and certainly the commentary around parks did the stock no favors. But what are we talking about really here? We're talking about one of the brands with the most loyal fan bases in the history of capitalism. Disneyland and Disney World are immensely popular. Even with all this nonsense about go woke, go broke. I mean, nobody's going broke here, right? They're increasing their net income is going to be up 30% year over year for this fiscal year. These segments make $15.5 billion and growing. So that go woke, go broke stuff is nonsense. It's a really catchy slogan. I'll give them that. But regular people without an agenda love Disney, and they go back year after year after year. So, for parks with this great brand, it's not going anywhere, and they've got phenomenal operating margins, usually mid-20s. Maybe it goes down to 20%. I think that's the bottom, the floor. And I ultimately think it's short term. I think by next summer, they said this might last for up to a few quarters. So that would basically take us to next summer. So I guess we'll have to see. But with that cloud hanging over shares, then the only thing that's going to break for shares is going to be the streaming business being profitable consistently and improving, right? We need to see like an improved trajectory over the next 4 quarters. And I think movies is going to be the extra kicker. I think movies is going to be, sell-side analysts are going to have their estimates, and movies is probably the segment that's going to help Disney as a whole beat consensus estimates. So this is a company that is probably going to beat going forward. But unless Disney Plus and Hulu specifically, forget about ESPN Plus, unless Disney Plus and Hulu turn a profit on their own and increase those profits quarter after quarter after quarter, that's what's going to save shares. That's what's going to actually get them to back up to 120, 130, 140. And if you get parks by next summer doing what they're supposed to do, growing, healthy, with the streaming business going great guns from a profitability standpoint, linear TV is not going to matter. I think it's going to be phenomenal. I am so bullish on Disney, not necessarily in the short term, not from a trade perspective, but gosh, I may get a lot of flack for this, but I think Disney doubles way before NVDA. Everybody loves NVIDIA. I love NVIDIA too as a company, but it's a $3 trillion market cap. It's already priced to perfection and even better than what people conceive of perfection. It is so expensive. And I've done a lot of analysis on that. I mean, I think it's going to grow revenues 5 times and profitability 5 times over the next 4 years. And it's great, but it's already priced in. I think it's going to take NVIDIA 4 years legitimately, 3 years with overly enthused investors to double from where it is. And I think Disney could double in 1 year. It's like an elastic band that's being stretched back, and it is set. It is almost there. It is almost set to be let go, with streaming turning profitable as I expect it to, and improve along with movies, and with the caveat that parks is no longer an overhang by spring. Then I think this is a stock. I think this is a stock that will work and really reward investors handsomely.